Okay, after all the financial statements are crafted, it's the financiers people's job to interpret the results and based on the numbers, we should analyze the firm's quality to see whether the firm is healthy financially or under distress or at the end of bankruptcy. Okay, we need to give an idea of the firm's quality based on the information on the statements. And here it comes to a new chapter, financial ratios. And we're going to deal with five major ratio categories. So these are liquidity ratios, solvency ratios, asset management ratios, profitability ratios, and market value ratios. Okay, the first two basically are debt ratios. Okay, these liquidity and solvency measures the firm's ability to pay off its obligations or liabilities or debt. Okay, so if the firm has a lot of assets, a lot of cash, that's definitely a good news. So that means the firm is liquid, is a solvent. Okay, the difference between liquid and solvent is the time period. So for the short term, it's called a liquidity. For the long term, it's called a solvency. All right. So if the firm does not have enough cash or have enough short-term assets that are readily convertible to cash, then the firm will be in trouble. Okay, for the next one, asset management ratio is also called efficiency ratio. That basically gives an idea how effectively do the managers manage the assets to generate wealth for the shareholders. And the next one is the profitability ratios that basically measure the firm profitability. You have a gross profit, you have operating profit, you also have a net profit. Okay, and the market value ratio is related with the stock market. You have the trading volumes, you have the stock prices that keep changing every second, and that's a different side of a financial market. Okay, so we're not talking about the total equity or book value per share on the accounting financial statements. Instead, we're talking about the stock price keep increasing every second or millions per second. Okay, that's a different system. All right, so first, liquidity ratios. As I said, it measures the firm's short-term obligations, short-term ability to meet its short-term obligations. Okay, and how do we measure this ability? Okay, so how do we measure the obligations? We're going to use short-term assets as the measurement of ability and short-term liabilities as a measurement of obligations. Okay, and how do we define distress? Of course, if assets is too low and liability is too high, then the firm is in financial distress. You have to make the money, use the money you make to pay off the debt all the time, and you do not have a lot of flexibility, a lot of freedom for any other uses. So that's definitely a sign of a stress. Okay, so what will be the solution? And here are the liquidity ratios we're going to practice with. The first is net working capital. So that gives a big idea of what the liquidity is. So you're going to use the current assets minus current liabilities. Current assets include cash, which is the most important assets in the world, and also account receivables, inventories. Current liabilities includes notes payable, accounts payable, and also accruals. Accruals are basically unpaid wages, utilities, and rent. All right, so the net working capital is measured in dollar amount. Okay, this is dollar, this is dollar. If you compare the net working capital of a small firm in thousands of dollars versus a big firm in billions of dollars, it's not really an apple-to-apple comparison because a small firm's dollar figure is too low. Realizing that problem, we have developed this ratio called a current ratio, where you use the current assets divided by current liabilities. So the scale would be, so the magnitude of the dollars would be scaled off. So you just get a mathematical ratio for comparison. Okay, that way you can compare the longevity and health of a small firm against a big firm, so they are put on the same page if you use a current ratio as the indicator. All right, the next one is called a quick ratio. The quick ratio basically made a little adjustment. You exclude inventory from current assets. Let's say your inventory, let's say your current assets include three things: cash, account receivable and inventory. Okay, so if you exclude inventory from your current assets, then what you get here is cash and account receivables. Do you guys agree? All right, and these are quick assets. Okay, cash is quick; you can use it right away. Account receivable is usually quick; you can use it after 2 weeks or a month or 3 months tops to cash out your account receivable or collect the unpaid bills to you. All right. However, inventory is not that quick. Okay, inventory is not quick assets. In order to get rid of inventory, you may spend a month or even close to a year to liquidate it. So that's why we exclude inventory from quick ratio. The next one is cash ratio. Okay, in the cash ratio, you further exclude account receivable from your current assets and retain only cash as the ability, as the measurement for meeting the ability to meet short-term obligations. Okay, the calculation of these ones are pretty easy. All right, the next category is the long-term solvency ratio. That's a firm's ability to meet these long-term obligations. So if you have a lot of debt, definitely that's not a quite good sign, because if you're running well, you pay interest to the debt holders. If you do not run well, more importantly, you also need to pay interest to the debt holders. Okay, and if you keep losing money and running a negative profit, and you still have to pay interest to the debt holders, your equity is going to be exhausted and eventually depleted, and the firm will be at the edge of bankruptcy. And the definition of a bankruptcy is the firm's inability to pay off its obligation. So if you cannot pay off your debt, you are broke. All right. So how do we measure these solvency ratios? The first one is a time interest to earn ratio. You are going to use a EBIT divided by interest. Okay, EBIT is your annual operating income and divided by the interest payment. So of course you want this ratio to be as high as possible. You want to have enough EBIT, enough profit to pay limited interest. All right, and then the next ratio is called a cash coverage ratio. The name has changed dramatically. However, the only adjustment here is depreciation. The story here is how do you get EBIT? You have a sales, you deduct cost from sales, you deduct depreciation from the sales, you get EBIT. Okay, if you add depreciation back, to the EBIT, so this will give you sales minus costs. Okay, so sales is a cash term, and the cost is a cash term. So this is a cash, this is a cash. Okay, let me just. All right, so let me throw away that wire. So this is so these are all cash terms. All right. So that's why it's called a cash coverage ratio when you combine EBIT and depreciation. All right, and also the long-term solvency ratio could be called leverage. Okay, leverage is the idea from the discipline of physics. Okay, when you apply that idea to finance, basically that would give your some power to generate more profit. All right. So let me just first introduce you some leverage ratios. You can use a total debt ratio, which is total debt divided by total assets. That's easy. And from accounting, you know that total debt is total assets minus total equity. All right. And you also have another ratio, which I want to stress a little bit more because we're going to use it later in another DuPont analysis framework. It's called an equity multiplier. You are going to use a total assets divided by total equity. All right, and this, if you do some math work, equals to 1 over 1 minus total debt over total assets. So the bottom line is you should know that if your debt ratio increase, then your equity multiplier should increase as well. Okay, so from the mathematical expression of the ratio, if there's a debt ratio increase, the 1 minus debt ratio would go down, so you have a smaller denominator, then the entire thing would go up. Okay, just remember that for the moment. Oops, sorry. Okay, so I want to say that when debt ratio goes up, your equity multiplier would go up. All right, so why do we call this a ratio leverage? It's because if you have more debt and you would get more returns for shareholders, okay? You will get more returns for shareholders. The presumption is you are running a positive profit, okay? You're running a positive profit. Remember, in physics, if you try to lift a massive weight, okay, if you just get very close to it and use your hands to do the lifting, it's gonna exhaust you. Okay, one way to do the work is to get a steel stick or something, and then you lever it up to lift it. So basically, you have a massive weight here, and when you use a lever, okay, if you use leverage, so you can just apply small force and to lift a big mass of weight. Okay, so that's the physics. In the world of finance, if you just have a small revenue, let's say if you have a small revenue, and if you just use leverage, okay, by borrowing more money in the world of finance, so leverage basically means borrowing, okay, and then you would achieve a high return on equity, okay, return on equity or shareholders' returns, okay, so this will go up. When you use a small force in physics, if you use let's say just a stick, okay, then you would lift up a big mass of weight, okay, and in the world of finance, if you have just a small revenue, but when you borrow money, you can use the money to buy more assets and expand your production level and also your revenue basis, and then you would reach a higher return on equity, which is important for the shareholders. Okay, so that's why in the world of finance we have this terminology called leverage. All right. So here is a summary that would remind you what we just covered. Consider alone which of the following will increase the firm's current ratio. First of all, if you get a question like this in your test, you should check the formula sheet and see what current ratio is. It is current assets over current liabilities. All right, and that's not good enough because you have to know what are included in current assets and what are included in current liabilities. And you need to rely on some external sources like your textbook, like your homework, and you take a look at the financial statements, and you, in particular, you look at the balance sheet and see what are included in the current assets and current liabilities. Okay, so option A, an increase in net fixed assets. Fixed assets is not in current assets, it's different. Fixed assets is long-term, current is short-term. Okay, so the increase of fixed assets does not change your current ratio. Okay, an increase in accrued liabilities would increase your current liabilities. Okay, because current liabilities include accruals. Okay, so when this one goes up, the entire thing actually goes down. Do you guys agree? That's math. All right. Option C, if a notes payable increase, the same story, your current liability would increase, the whole thing would go down. Okay. Option D, account receivable increase. Okay, when you have account receivable increase, then current assets will increase, and then your current ratio will increase. So that's our guy. We should select option D. Option E, an increase in accounts payable, is we reject that for the same reason we reject the B and C. Okay, because account payable is part of a current liabilities. Okay, the next one is actually more interesting. Okay, the next one is more interesting. A company has a current assets of $5 million and a current liabilities of $10 million. Consider alone which action would increase the firm's current ratio. All right, so what is the current ratio now? Let me put it here. The current ratio is current assets over current liabilities. Right now, it's a 5 million for current assets, 10 million for current liabilities, so it's a 0.5. And what action would increase the current ratio? Sorry. what action would increase the current ratio? So option A, let's say option A, borrow short-term notes payable at 1 million and use the cash to increase inventories. This is actually two dynamic stories. Okay, if you borrow money in the short run, your cash will increase. Okay, that's story number one. Story number two, if you use the cash to increase inventory, your cash would go down to the original level, your inventory would go up. Okay, so option A gave you this story. Your cash increased by 1 million, and then your short notes payable would increase by 1 million, same amount. Okay, and then your cash gotta spend to build the inventory, your cash go down, and your inventory would go up. Okay, so eventually the cash effect is zero. Do you guys agree? Cash go up by 1 million, and then you spend it, so you go down. So you would have a notes payable increase and then inventory increase. So notes payable is part of current liabilities. Okay, so this would add up by 1, and then current assets will also increase by 1 because your inventory increased. Do you guys agree? So eventually it will be changed to 6 over 11, and that is actually greater than 0.5. Okay, I know that for sure. That's greater than 0.5. 0.5. All right, so A is our guy. We should select A. All right, for practice reasons, let's go over the other options. Option B, use 1 million cash to reduce accruals. Okay, use 1 million cash to reduce accruals. So in option B, if you use the cash to reduce your accruals, basically you are paying off your rent and utilities. Your cash would go down, and accruals would also go down as well. Okay, because we have less bills to pay. All right, when the accrual go down, so your current assets is your current liabilities go down from 10 by 1 million, so that would give you 9, and then your current assets would go down by 1, give you 4, and this would be less than 0.5. Okay, if you do the math, it's 0.44 or something. All right. Option C. Use the $1 million cash to reduce accounts payable. It's the same story as option B, okay, except you're using account payables, not accruals. So your current liabilities reduced by 1, your current assets reduced by 1, so you would reach a lower current ratio. All right, option D would be the same, okay, option D would be the same with option B and C. Option E is a little bit different. Use $1 million cash to reduce long-term bonds. So in option E, your cash also decrease, and your long-term bonds, okay, also decrease because you have less bond outstanding. Okay, you have less bond floating in the market. So, but bond does not belong to current liabilities. Bond belongs to long-term liabilities. Okay, so your current liability will stay the same as 10. Your cash is used, so you should have 5 minus 1, that's 4. Okay, so you use 4 over 10, and that's less than 0.5. All right, 0.4 is less than 0.5. Okay, so this is a good practice, and you are going to do the same thing in your assignment, and perhaps, very likely, I would say probably you're going to do the same thing in your first take-home exam. Okay, so for now, let me stop right here, and let's go over assignment number 1. Okay, assignment number 1. So in assignment number 1, you have some questions here. Well, first of all, there's instructions for it. How to submit the homework. Let me skip that one. And you have first 4 questions that are related with chapter 5, time value of money. Okay, just to go over the videos, you should be able to handle that. Okay, and question 5 is really I want to talk about now. All right, question 5 gives you a financial statement. Okay, I see that's the financial statement you have. You have a income statement, balance sheet, and you also have a statement of cash flows. And you are going to solve for whatever being asked here. You need to first tell the cash and the cumulative depreciation right here. return earnings right here, and time interest earned ratios and the quick ratios. So these are all easy tasks. For cash, you can basically use the total current assets minus these two, or you can use last year's cash balance minus or okay, the last year's cash balance minus 5,600. Okay, this is another way to get a cash level. Accumulated depreciation basically is last year's accumulated depreciation plus this year's depreciation expense. Okay, and return earnings is the last year's return earnings plus net income of this year minus dividend of this year. All right, and the time interest earned ratio, you just follow the formula on the PowerPoint, and you will find EBIT and you will find interest. Okay, so and then calculate it, and you can get a quick ratio very easily. Okay, and for the change of account receivables on the statement of cash flows is right here. Okay, and remember, account receivable is a assets. Okay, that's an assets. So when you see the assets for that, okay, increase from 351 to 402, actually it should have a negative cash effect. So your cash should be reduced. So you should have a negative number right here. Okay, so you should have a negative change of account receivables just because it's assets. For account payable, it's a different story. It is in liabilities. So when you have a more, when your account payable increases, then basically you save money by not paying your debt. Your cash would increase. And cash dividend paid right here, remember, it should be a negative number. Okay, the next one is based on the provided financials. The firm sales is the inventory by $20,000. Assume no other activities take place. What is the new quick ratio? All right. So what happens here is number one, you need to know what made up a quick ratio. Okay. And then number two, you should know what is the story here. Okay, what is the story here? So basically, your quick ratio is current assets minus inventory over current liabilities. Okay, and you need to find what's the number here for current liabilities from the financial statements. That's an easy job to do, just to look for the number, total current liabilities. And you can also easily find the number for current assets and inventory and get the quick ratio done. The thing is, you need to know what happened to the factors or the variables after the firm sells its inventory. So when inventory is sold off, so what happened to your inventory? You have a less inventory, right? The inventory would decrease by $20,000. Okay, so you have less inventory. If you sell inventory, of course, you're going to receive cash. So your cash level is going up by 20,000. Okay, so what would apply to your quick ratio? So what happened to your total assets, first of all? So your total assets equals to inventory plus cash plus account receivable. Account receivable is the same. Inventory is reduced, cash increased. So basically the net change is zero for current assets. So this part stays the same. Current assets stay the same. And for inventory, it will be reduced by $20,000. So after that happened, after inventory got reduced, okay, that's the only change you need to make in the quick ratio calculation. And all the others would maintain the same. The only thing you need to do is to get a lower inventory, which is a $20,000 less than the inventory given in the financial statement. Okay, and the next one, provided on the based on the provided financials, the firm increased the debt by $20,000. What's the new total debt ratio? Assume nothing else has changed. Okay, so once again, you follow the same protocol. You write down the formula for total debt ratio. Okay, that's your total liabilities over total assets. Okay, and then your story is your long-term debt is increased by 20,000. So basically, your long-term debt increased by 20,000, and then what happened? This is long-term debt. Okay, not total debt. Long-term debt. So what happened to your total debt? It would increase by 20,000, right? It would increase by 20,000. And what happened to your total assets? The story here is when you raise more debt, when you collect more capital, you would have more cash in your pocket. You just borrowed more money, so you should have more cash in your pocket. That would increase by 20,000 as well. And remember, cash is a part of your total assets. So when cash increase, your total assets increase by the same amount. So to get the new total debt ratio, you should use the old number, total liabilities and total assets from the given financial statements, and then add 20,000 on each of them. That's how you solve for this question.